Good afternoon, everybody, and welcome to Scope's webinar on European real estate. Is the worst over for the corporate credit outlook? My name is Dirk Brandenberg. I'm Scope's head of ESG and credit research, and with me today is Philipp, an executive director in our corporate group in Berlin, and Thomas Faeh, executive director with our corporate team in Oslo. Today, we're going to talk about probably one of the most topical sectors out there in terms of credit events over the last 12 months. To break this theme down, if you look at the agenda, we're going to talk through the outlook for European REITs, Nordic REITs, our own rating actions this year, and then our long-term outlook from here. Before we start, let me remind you, you can download the material, which is at the bottom right-hand of your screens, I believe. And you can also ask questions in the chat function that should be available on your screens. So with that, I will hand it over to Philipp to kick it off on our European REIT outlook, and then we take it from there. Philipp?
Wonderful. Thank you, Dirk. And also warm welcome from my side. And the slide I show to you right now is just a quick refresher. So you see actually the link in between the interest rate environment and the development of cap rates. So what we see here is still an inverse yield curve. Yeah. Is it pricing in a recession? No, not really, because there are just a few exceptions, at least to our forecast, where a recession could really occur this year or even next year. But what we can see, of course, if we compare that to the yield curve a month ago, 2 months ago, or whatsoever, that the distance in between the trough here of the forward and the current peak actually is narrowing down. So we are getting more and more in the normalization of the yield curve or interest curve. So that actually supports the view, also if we look at the forward, that we will be exposed to higher interest rates for a longer period of time. The cap rates are still on upwards trajectory. And the strongest increase actually was experienced by residential properties. That is at unprecedented heights. Yeah, if you look at the cap rates for, this is really good quality, so to say, multifamily properties over the last 2 decades, actually these heights haven't been achieved in the last 2 decades. So is actually the decline in values now over? Yeah, we'll touch base on that in a second. And the current spread between the risk-free return and the combined commercial yields around 190 bips. And if we look at the median over the last 10 years, it has been 366 bips. So that actually would point to further widening of cap rates. Yeah, but if we also consider that in the last 10 years, we have been in a very exceptional period. So since the Euro crisis, actually the risk-free returns declined, and the spread in between all the different asset classes and the risk returns have been rather high. So sparing that out and looking at a more longer period of time, so the last 15 to 20 years, what we can see here that is actually that the spread in between the risk-free returns and the commercial yields has been around 200 to 225 bits in about 30% of data points. That means maybe, there is a risk, of course, for further yield widening, but maybe it's not as high as people might fear. Yeah, but maybe. I'll touch base on this in a second. So this is, as I said, just a refresher. Now, also a slide that is familiar to those who also attended the last webinar and the webinar beforehand. This is where we show you a comparison of the development of interest cover hedging ratios and weighted average cost of debt across the group of now 53 peers we have in our coverage. 57 peers we have in our coverage in comparison to the 43 we had beforehand. So there is a further increase in the weighted average cost of debt that is now at 2.4% at end of H1. And that does not come as a surprise, but this is not at the end of the road. As we expect interest rates to be higher for longer, we rather expect that the average cost of debt is increasing to 4%. but only, so to say, also for the companies that, have a robust cash flow profile, and limited debt burdens. For others with not such a robust cash flow profile, depending on the property types and locations they're in, and maybe a higher debt burden, even this is out of reach. So interest cover remains comparatively weak and is even declining for companies that do not have such a very, let's say, stable revenue profile. And what we expect here is that interest cover will decline further. So we will see interest cover in the median or average will decline to below 3. And the speed of transition really depends actually on the individual maturity profiles and on the company's access to the different financing sources. And access becomes key because there's a rather large refinancing challenge that looms. If we just look at the capital market that is outstanding, next year companies have to repay or extend financing in capital markets that is almost at a similar level as this year. But the year thereafter, we'll see a further increase by 30 to 40%. So what are companies doing? They are moving again away from the capital market to secured financing. It's a reverse direction we actually experienced since 2012, and companies are tempted to go to capital markets because it was very competitive in pricing and there have been less covenants attached, so it was much more comfortable to have this kind of financing. But secured financing is only available for companies that have a healthy balance sheet, and banks are actively requesting that companies, if they have an unhealthy balance sheet, do their efforts to clean these balance sheets up. And also banks do not have unlimited means of providing financing. So what do companies do? There are alternative ways. Go to the capital market, but even there, they have reopened. That's a cool feature, but not to the extent actually they have been open in the last years. But the spreads or the margins companies have to pay increase tremendously across all the rating categories, and much more pronounced for high yield issues where we see margins of around 600 to 650 bips on the mid swap. Just for a 5-year tenor or so, increasing the financing to around 10%. And this is not sustainable for some issues. So next way, more and more alternative lending becomes attractive. So the private debt market or private equity market. And the benefit of these alternative lending is that they are made to measure. So they're focusing on the specificities of the issue in question. They have a very high execution speed. And more, they are also competitive in terms of pricing. So we see this in several of our peers where private equity has been, so to say, directed to co-finance a joint venture portfolio, or where private debt has been deployed, where we can see financing terms that are between 5 to 6, 7-ish% for even very high LTVs. And if all of this doesn't work, companies, might tap the equity market, but if they haven't succeeded to tap the markets before, they won't be able to tap equity markets as well, especially as the depressed share prices point to very high costs. So there won't be any access to financing at all. And this will also, so to say, guide the future. So we will see a higher differentiation in the cost of capital, and this will also cause a higher differentiation in the overall credit quality, ultimately leading also to lower interest coverage. And banks, this is a good sign, are increasingly open, as far as we understand from market feedback, to accept lower ICRs to reflect the changed interest rate environment. Then the short, same peer group, not the same message. You can see that the leverage remains more or less stable, that there have been some fair value declines, and there was very strong pronounced rental growth. The problem here is really that we have less of an evidence because there is a standstill on the investment market. So the values have less of evidence to really adjust property prices. And even ECB is now asking property values to explain how they compile these, so to say, estimates, as they're increasingly concerned about, so to say, appraisers might be too slow to mark down prices. So we might see further fair value declines here. And the best way of issuers to handle this situation, also having in mind the refinancing issue, is just to sell assets. Yeah, to delever by freeing up capital and repay debt. But yeah, even this comes with a caveat. Yeah, if you want to sell assets, yeah, you also have to consider the buy-side financing. And buy-side financing already is exposed to these higher interest rates. So what we believe, yeah, that there will be additional pressure on property values, even so to say, if you're not a distressed seller, because you might not be able to sell at prices that do not reflect the current interest rate environment. So property prices are expected to go down. And to give you just an example, if you just look at the widening of cap rates for office properties in the last 12 months, they widened to an extent that would actually reflect the decrease in property value by 30%. Yeah, but what we've seen in our peer group, and I show that later, is around 3%. So what's happening there? So of course, there's some rental growth that offsets this widening cap rates, but there is still a long road to go to actually bridge the gap. Get to that later. And what we believe here in the future is also that there will be a higher differentiation with regards to the leverage. Also, the top of the crop will, so to say, be separated from the rest. Yeah, there is little room for middle ground in our view. That means companies that have a decent size of their portfolio, that actually enables to have a high level of diversification, that also have a decent property quality, yeah, especially ESG related or with regards to location, that will be able to find access to financing, that will be able to find buyers that are willing still to say to pay a premium because they have a premium product, and this will support leverage. Yeah, but especially if you look to the say at the longer tail of properties that might not fit the same to the high quality aspects. Yeah, we have of course these large issuers that have high quality properties, but the majority of the European property stock is not high quality. Yeah, so it's facing a lot of ESG related risk, yeah, not only with regards to demand from tenants, but also with regards to potential intervention from regulators, to literally weatherproof the assets and to spend a lot of money. And to be able to spend the money, actually you have to have financing in place. And as I said, this becomes a key challenge. And as a consequence, as I said, higher differentiation also on that end with regards to leverage. And having that said, I will hand over to Thomas.
Thank you very much, Philip, and also a warm welcome from my side. I'm going to focus on Nordic real estate. Sitting in the Nordics, it's close to heart for me. Now, what we are seeing here, and it's a bit of a different or a special case, one could argue, is some sort of a structural issue. The Nordics, the REITs in the Nordics finance themselves on a relatively short-term basis compared to continental Europe, and predominantly on a floating rate. So bond tenures are 3 to 5 years, and banks are similar in that sense, which requires the companies to refinance on a constant basis. In addition, the floating rate debt exposes the companies obviously to a very severe risk in terms of interest rate increases. And what we've seen before these significant rate hikes here has been a hedging level of about 70%. Now you might recall from Philipp's slides before that across Europe we have a hedging ratio of around 90% plus. So 70 is relatively weak to start with. And now the company's intention was to probably increase these hedging ratios as interest rates go up. But given the very drastic and fast-paced interest rate hikes we've seen, this proved to be very difficult and costly. So what we are seeing currently is a relative unchanged picture of an interest hedge ratio at around 70%. This naturally feeds through the interest cost. The average interest cost has significantly increased. And you can see on the left-hand side, interest cover thereby reduced. Now, how are the companies trying to mitigate these factors? Well, in one sense, the rental income, at least on the commercial side, is predominantly CPI linked, which helps a lot. Sweden had an uplift of 10% coming into 2023, Norway of 8-9%. A further mitigant is the switch from unsecured to secured lendings. The banks are there to lend, and that dampens the speed and the cost that we're seeing based on these interest rate increases. Now, further cuts of dividends are helping the case, and deleveraging efforts, which are not easy in that current market. If we look at our recent downgrades or negative outlooks that we assigned, what explain those? We have here a tale of two sides. Operationally, the companies are doing fine, and it looks like they're also gonna do relatively well in the future. We have low vacancies, we have stable vaults, we have rental income increasing thanks to the CPI links, but we have the financial side that was mentioned by Philipp, that is very difficult to manage for many issuers. If you look at leverage, it's relatively unchanged. Companies have managed to manage leverage through disposals and through repaying maturities with cash flows, despite the fair value adjustments that we've seen in 2022, around 2%, year to date, around 5%. There is more to come on that one. I'll come to that in my outlook section. What has driven the downgrades is predominantly the interest cover, which has deteriorated significantly, as you've seen in the previous slide. In addition, on certain specific cases, we've also seen curtailed access to capital markets, which have been a driver for downgrades. Now, what is the outlook for Nordic real estate? In our view, interest rate risk is in a way priced in. We're probably about to see the peak of interest rate hikes. We're going to see higher for longer, but then at the same time, an impending recession could bring back targeted fiscal stimulus, at least for households here in the Nordics. Where we have a high uncertainty is on valuations, where we've seen some write-downs, but if we believe yield widening, there could be more to come. And here I'd like to show you on the right-hand side the transaction values that we've seen in Sweden and also in Norway, which have really decreased over the last 2 years. And this is the struggle that independent evaluators are having, putting their finger on asset values, because there's not much transactions around to compare to. So, and the ones that are going through, one could question, are these distressed sales that need to go into the market to create liquidity for the issuers, or are these actually the best assets that still find a buyer to buy? So this kind of questions make valuations very difficult these days. Also, the recession looming. Sweden is technically in a recession. Norway will likely scrape through thanks to oil. Finland a bit undecided on our forecast. And then we see a recession risk for Lithuania and Estonia, also as part of the wider Nordics. So this is a topic that we also see here in the Nordics. With that, I would like to wrap up and hand back to Philipp.
Thank you, Thomas. So what is actually the result of everything we highlighted so far? So ratings are forward-looking, and they try to capture already the risk that is ahead of us. And what you can see here is on the left-hand side, the individual contribution of the individual rating actions, whether they have been negative, stable, or positive to the overall rating actions in a specific quarter. Just to be also very precise on that, negative does not mean downgrade. Negative could include downgrades, but it also includes a change in outlook, for example, from stable to negative or from positive to stable. So every negative movement that occurred. Positive, of course, the other way around. It's not only upgrades, it's also a revision of the outlook from stable to positive, negative to stable, all on the review for a possible upgrade. That means the share actually of these negative rating actions increased a lot in the last couple of months in comparison to what we've seen in the last 4 years. So if we look at the 12-month trailing rating drift, that means it is a comparison, or it will be computed as negative over positive rating actions in comparison to all rating actions that have been executed. You see, we had the first dip when the COVID crisis actually hit. Then we have been rather balanced, slightly negative trend, but then actually after, so to say, the realization of this change in interest rate and how fast it has been actually executed, was there actually the rating drift deteriorated massively to now minus 50%. What you can see, of course, is the two circles at the bottom right are a function of our ratings coverage. So if it comes to countries, we see most negative rating actions, or we've seen the most negative rating actions in Germany, Sweden, Austria, and Hungary. Whereas if we go to the property types, of course, commercial property holders and home builders and multifamily are impacted the most. But with regards to severity, for multifamily, the severity was not that much, but the severity was rather on the side of the home builders and on the commercial property owners. For the commercial property owners, one of the leading factors there was really issues with regards to the interest rate hedging, so inadequate hedging strategies that led to a deterioration actually then in the interest cost coverage. And for the home builders, it was just a total drop in demand. That means home builders, developers are facing a situation where the demand is not really existing on the one hand, so they are not able to sell something. On the other hand, they have to extend the financing for the ongoing projects as they are not able to find potential customers. And that just squeezes out liquidity of this sector at a tremendous speed. And we've seen this with a lot of bankruptcies, especially in Germany. Goody. But what is the outlook? So to sum up what we already saying, so refinancing as a highlight is actually now the key issue. So on the top right, you can see the chart of the loan maturities, not loan, the bond maturities of European issuers and the capital market. You can see there, this curve, it looks like a pyramid, so peaking in 2025, 2026, and this is just also a consequence of the hunt for more debt, of the real estate sector, but also, as I said, of the shift actually from secured financing to capital market debt we experienced since 2012. And now these bonds mature year on year, and refinancing risk is, so to say, increasing as refinancing via capital markets is, under nowadays conditions, extremely costly. And here we can see that in the next 3 years, so from 2024 to 2026, there are 121 billion euros due to be refinanced, and this is even more that has to be refinanced in the preceding 6 years. So it's a lot of money that needs to be refinanced. As I said, there are not that endless opportunities actually to refinance the whole thing, especially having in mind that the interest rate environment will look as it is right now for a long period of time. So these increased cost of financing will really feed into the income statements, cash flow statements, and balance sheets of the companies, so higher for longer. And as a consequence for that, we will see a further decline in property values. And on the bottom right, you can see what are our estimations And the dark blue part here, the H1 2023, is what the peer group we cover actually just to say reported in negative fair value declines. So it's 6.1% for residential, 3.6% for office, very negligible for retail and for industrial. And the red line actually represents the decline we could expect if we, so to say, believe that the median spread to the risk-free return will be as high as it has been in the last 15 to 20 years. That means there is still some way to go. It already captures also rental growth expectations. Yeah, that means if rental growth expectations turn out to be not as good as we believe, then so to sum it up, also maybe you wondered because of industrial there is no big change actually anticipated. There we already captured in the structural shift in demand from investors that happened in between 2016 and 2019, where yields just tremendously decreased, and now it again moves, so to say, highly correlated to the other yields of the other sectors. For retail, actually, the change happened already since 2017, 2018. Yeah, so and COVID actually accelerated the change or the increase in cap rates. So more or less, a lot of has been digested. This is just for prime property here. For office properties, there is an additional downside risk to what you can see here because there is a structural shift with regards to demand. Yeah, but as long as we cannot size it, this is our best guess here. And for residential properties, if we just double, so to say, the decrease of H1, we might already have the value where we believe it needs to be. Yeah. The only problem with residential is that, or the upside or problem, we can look at this from two ways, is that they mostly operate in regulated markets or regulated environments. So rent increases are not, let's say, possible to an extent they would like to do it. For the other sectors, we have this rents that are linked to consumer price indices, and thus they benefit from the inflationary environment. But in an inflationary environment, residential is lagging a bit. But it will do better if inflation goes down. Yeah, so this is the only downside. But having a final, to say, just quote on that here, having in mind the tremendous amount actually of debt that needs to be refinanced, having in mind the impact this will have on the cash generation of the companies. Yeah? They have to pay the high interest rates and they won't be able actually to repay the whole debt. They have to refinance something somehow. Actually, this is a real burden, especially in an environment where additional investments is needed. Yeah? Just from an ESG perspective, there is a very high amount needed to literally weatherproof the European property stock or to make it carbon neutral. And these investments are not even factored into these refinancing needs because these are additional financing needs. Now, these are additional risks that loom that could lead either to a deeper devaluation, yeah, because then values need to go down to an extent that even these additional investments make economically sense, yeah, or on the other way, there needs to be some support in whatever way, yeah, that the real estate industry can actually bear its burden if it comes to the EU goal to be carbon neutral by 2050. So just also to don't say everything is super crazy, super risky. We do not believe in a systemic meltdown, but as I said, there is less room for middle ground and there will be a higher differentiation of credit qualities. Thank you.
Yeah, thank you, Philip. Thank you, Thomas. Very interesting points you're making here. Maybe just since we're just on the refinancing chart here, and also sort of going back to your previous remark that you think the sort of all-in cost is about, I think you believe you said 4%. You also, or you expect that to rise to 4%. We've seen yields on these assets somewhere sort of 4 to up to 5%. I mean, this 4% refinance, but I mean, how much room or what kind of capital structure will companies need really here to stay competitive, and what's their potential here to keep on issuing into capital markets, particularly this year and next?
Okay, so first of all, the 4% is, as I said, just for the top of the crops. Yeah, so if you really have a rock solid portfolio that provides sort of rock solid cash flow, and if you of course have a large size to really have access to all sorts of financing. The capital structure that is actually needed is the very same as prior to the crisis. You need to have a low leverage. That means you need to have a high level of equity, either of, so to say, hard equity provided by investors, or, so to say, the hidden equity, which is then just the difference between the hard equity and the net asset value of the property portfolio. And if you're not able to have that, so maybe expressed with an LTV of sustainably below 50%, if not rather tending towards 40% to capture the risk right now, then, as I said, 4% won't be reachable. And you need to find other ways to finance yourself.
And capital market issuance in this environment?
Yeah, it really depends. It can be seen as a sign of strength if you tap capital markets and have reasonable conditions. So this will might reinforce the standing in the capital markets, but also among other investors that provide equity, or also for secured bank financing. But what we will see is not that much of issuance activity in capital markets. So as I said, it's just too costly. And if you are really facing margins of 600 pips on the mid-swap, yeah, and then you have a 10% debt, yeah, so cost of debt, whereas in such circumstances, maybe your LTV is 60%. Then if your property portfolio is yielding at 5% or even 6%, yeah, you will just burn cash in the end, yeah, because you have all the operational expenditure. So this is no way to go. So in the end, in these circumstances, as I said, you have to sell assets to deleverage, or you need to attract in any way equity to reduce the leverage. So leverage reduction is key. And if everything is not working, then you have to restructure also your liability side. That means you have to restructure the debt that is on your balance sheet.
I guess that explains our large proportion of negative rating actions and also the ongoing negative outlooks we have on a lot of issuers in this sector. Now, thank you, Philipp. You mentioned it already, the role of the banks. They always have appetite for assets at the right price and the right LTV, and particularly given the funding pressures in Sweden. I wondered whether, Thomas, I mean, you got any views here in terms of what role bank financing can play for these companies? I mean, given some of the very high quality assets they appear to have.
Yeah, certainly. I mean, what we've seen and also the feedback that we get is that banks are standing by. They're helping existing clients to refinance debt, mostly on a secured basis, and they are there to help their existing clients through this trough here. They're not there to finance any new projects or acquisitions. So we see all the listed REITs being net sellers at the moment. They still need to deleverage. And that's also one of the requirements that we have learned recently from banks, that they want to see some sort of deleveraging. And in return, they're willing to maybe accept lower interest coverage ratios as they previously had. So overall, it's still supportive pictures from the banks. Yeah.
And maybe it's a question for both of you that just came through actually on the chat. Very good question. I mean, how much leeway do, I guess, both the the mortgage finance companies, as well as the banks have in terms of covenants? I mean, is there, as you know, interest rate cover comes down, LTVs go up? What are the constraints here? Are there any constraints on issuers in terms of the flexibility they have to operate here and move their assets?
There are some constraints, of course, but if you look at, say, the typical debt capital market covenants, if we talk about LTV of 60% or interest cover of 1.5 or something like this. So for the interest cover, we are far off, at least for those more, let's say, for the companies that have an adequate hedging strategy. So they have really time to grow into that higher for longer, as to say the rental income profile will be positively impacted in the next years. With regards to the LTV, if we just see that the LTV for our peer group at least remain unchanged as the leveraging efforts bore fruit in a way that the negative fair value adjustments have been offset by the debt repayments. And if we then for multifamily, let's say, okay, another 10% in fair value decline, and we have a 50% LTV maybe on multifamily on average, I can look it up in a second, it's lower, then you would end up with an LTV of 55%, which is still away from the 60% covenant. Of course, this might look different for other issues, but in general, yeah, there will be some constraints going forward that covenant breaches will be more likely, but rather on an individual asset base, or secured financing base, I would expect, at least with regards to the coverage I have, and not on the whole portfolio level.
Okay.
And just to add on the Nordic side, I mean, it obviously depends how strong the fair value declines will be in the future, but it's a similar picture as Philipp mentioned, that this could, if it's a very pronounced impact, this would obviously limit the possibilities for issuer to move and get very close to their covenants level on LTV side. But actually, I see more of a risk there again on the interest coverage ratio, which is still exposed. That continues to deteriorate and eventually might become an issue.
Okay, thank you. Maybe going over to valuations, I think you do show some of your views here in terms of the downside, potential downside is still there as valuations catch up with yields. One question that came was, I mean, this other effect you mentioned around investment that's required in properties. I mean, in particular, I would say in the office sector. I mean, how much differentiation of yield of value drops can you see for office properties, especially also between, say, newer and greener buildings, older buildings? I mean, is that gap going to be widened, and is that going to be a very significant driver of performance going forward, particularly since you mentioned the investment needs are so high?
Yes. To cut it short, yes. So it's really more focused now on the typical things I also learned during my studies for real estate. Everything that counts is location. And the only thing I can add to this right now is really, so to say, the quality with regards to the ESG conformity. So is it new? Is it, so to say, very flexible? Are there any investment needs ahead? So that all will be captured actually by potential investors. And if you have a rather new portfolio in good locations where demand is healthy, then actually the pressure on your fair values is not as high as you have anything else. And again, to restate that, even if we now look at the REITs, but if we look at the whole European property stock, then the average quality is not so, let's say, satisfying. Yeah. So for the REITs, they might have a better, so to say, a cherry picking, not that they have the best assets, but in comparison to the overall property stock, they have better assets. So the real impact might occur rather on the private end or the unlisted end.
Okay, great. Thank you. Maybe just one other observation here. So I guess the majority of the highly rated larger REIT companies, they entered this whole period with pretty long-standing, mostly BBB investment grade ratings. I mean, in your view, and also I guess from a pure rating perspective, is that still a realistic sort of rating level going forward for this type of business model, or is there just the path here is so narrow now with regards to the asset and liability mix you need to achieve these ratings or maintain them going forward? How do you see that developing?
As I said a couple of times, I personally do not believe really in the middle ground. And the middle ground is really these crossovers, so low investment grade, strong high yield ratings. As these ratings already, so to say, captured some weaknesses of the issue of regards to its financing or business risk profile. And these weaknesses, as I said, they will lead to a higher differentiation. That's also written on the slide along the cost of capital. So if you're weaker, you have to pay more, and not even just a fraction more, but substantially more than if you have, so to say, a rather good portfolio and stable cash flow and whatsoever. And the same is, so to say, true that the differentiation will also be based on the quality of assets and the property type. As I said, if you have good quality assets that are well in demand, then there won't be that much of an adjustment. Whereas if you have the rest, there will be a lot of adjustment, because we cannot forget about the rest. As I said, the EU has a goal to achieve carbon neutrality by 2050, and this goal needs to be, so to say, somewhat tackled by the real estate industry, and to be able to do so, the returns for these investments needs to be satisfiable for investors. And to achieve that, especially for the weaker part of the property stock, the devaluation is a prerequisite, and in some circumstances a massive devaluation. But this, as I said, will lead to a high differentiation of credit quality. So we will see still some strong and very strong credits, but we will see an increasing number of, let's say, double B-ish, single B-ish credits, I would assume.
Okay. The other question, I think we discussed it on previous calls, is the individual loan performance and what that could mean for other sources of financing, in particular CMBS. I mean, if you look at your sort of valuation picture here, is that, does that equally apply for other, outside of the real estate sector, or is there any, outside of the finance company real estate sector, are there any sort of laterals people can draw from this analysis for related asset classes? Is there anything you can comment on?
Not really right now. So best is to directly pick up the phone and ask the relevant analyst. But we can share this.
Okay, so yeah, indeed, we do have a research piece out from you, Philipp, that came out this morning, which is available on our website. And equally, we have some updated views on CMBS on there, although clearly this remains a developing subject, as we have seen in this presentation today. Well, with that, coming up to the 45-minute mark, and I appreciate the patience of the audience here, and also appreciate the two presenters here. But since there are no more questions from the audience, I will close this call now, and I hope to see you all soon on another Scope webinar. Thank you very much.
Thank you. Bye-bye.